Good afternoon, everybody. A new year, a new start. What will stock markets look like 3, 6, 9, 12 months from here? With me in the studio today is Dylan Wickramasinghe, Maybank Securities Research Head. We'd like to get into his thoughts about the Singapore stock market, what are the drivers that will move it, his sector favorites, and stock picks. So let me turn to my guest right now. Dylan, good afternoon. Welcome to the show. It's so refreshing to start the week with your latest thematic report on Singapore. The Singapore equities market has had a very nice strong run in 2025, up a commendable 23%. In your report, you talked about the certainty premium that markets accord to Singapore. What's in that certainty premium?
Sure, Sanya. It's good to be back and good to be on the other side of the table for a change. Look, I think if you look at how this year started, when you had one country kidnapping another country's president, you know we are not in the same world that we lived in last year or 2 years ago or even 10 years ago. That unipolar, low interest rate, low unemployment world is fast disintegrating. And I think what it's being replaced with, we don't know yet, but we are in that journey. So, and I think that is causing a lot of investors to look for certainty, looking for certainty in terms of political certainty, looking for certainty around policy, as well as looking for certainty around economics. And I think in those factors, Singapore has actually stood out really, really strongly. And I think that's part of why we saw this 23% market re-rating last year. And I think that can continue going into this year as well. I think the clear part about Singapore is the stability that the government is giving. You know, they had a landslide election victory in 2025. That puts a lot of policy stability in play. We also seen in the last 10, 15 years, when Singapore has gone through major crises, like the global financial crisis or COVID, we've seen the government actually step in to actually de-risk. We saw massive amounts of fiscal stimulus being pumped into the economy. So we know what the playbook is when things go south domestically as well. So I think all of that puts Singapore in a much more stable and certain position compared to some of the other regional peers, as well as some of the other global developed markets as well. And that's the certainty premium that I'm talking about. And I think that'll drive more liquidity coming into Singapore this year as well, Sanya.
Okay, all right. So let's talk about that playbook. And to drive the index further, obviously we have to look at the index stocks for a start. What kind of reforms have we seen in the for Singapore GLCs so far, and what can we expect this year?
Yeah, so we've already seen some very strong restructuring and reforms happening, starting from 2020, when a lot of the Temasek-linked companies start to think about how do they actually increase their ROEs, how do they reformat their business models to fit into this new, new world that we're operating in. How do they take on challenges like AI and so on as well. So we've seen a lot of restructuring happening so far in the last 5 years or so. But what's interesting is, and the markets have actually rewarded them with very strong re-ratings. You can see that with share price performance of, stocks like Sembcorp, Keppel, STI Engineering, and so on. But for me, what actually quite interesting is pretty much most of, or almost all of that re-rating was driven by earnings growth. Now, if we actually look at some of the other developed markets regionally, like Japan, Korea, and even Hong Kong, what actually stands out is a lot of the large cap re-ratings over the last few years have actually happened from multiple expansion. And in Singapore, you haven't actually seen that much multiple expansion at all. Multiples probably accounted for about 20% of the re-rating, 80% of it actually came from earnings. So So the good news is that a lot of the reforms that are happening in Singapore are working because that's actually driving earnings growth. And we think that a lot of the large caps will continue to drive earnings growth over the next few years. But we also think that their multiples will also start to catch up with some of the global peers as well, and I think that's quite interesting. And I think part of that process will be capital returns when they look at trying to lighten their balance sheet. So we think dividends will increase. We are forecasting dividend growth to be at about 9% CAGR over the next 3 years versus about 5% CAGR over the last 10 years. So, almost doubling. We're also seeing share buybacks taking place. Share buybacks today by the large caps are at a decade high. So again, very, very aggressive capital returns happening here as well. And my final point there is actually the Temasek reforms that happened last year around August. Here, we saw that Temasek being, reformatted with one part of the asset manager now going to be looking exclusively at their domestic investments, which are the Temasek linked companies. So, which means that there will be extra focus on these domestic companies to squeeze out even more returns. So I think that gets us to be a lot more excited about where return on equities for these companies can go. Indeed, ROEs for the large caps are a lot lower compared to the regional indexes like the Nikkei 225. They're probably similar levels of ROEs. Hong Kong is about 200, 300 percentage points higher ROEs. US is significantly higher, 500 basis points sort of higher ROEs. So I think there's a lot of catching up for the large caps to do, and I think that'll happen this year.
Oh, that sounds really great. Do you see a broadening of the market breadth with the mid and small cap segment then?
Yeah, so I think what's interesting with the small and mid caps is, there was quite a few announcements last year from MAS, and the MAS sort of market, make Singapore great again sort of reforms are now complete. The report came out in November, and there has been quite a few really, really good, reforms that were in there. And I think we did see on that news a lot of the small and mid caps actually rallying with that. Now, what's interesting is that, and this is something that a lot of investors keep telling me as well, a lot of the small and mid caps have now run. There isn't really much to buy now in Singapore because a lot of these companies are already expensive. But to me, what's actually interesting is despite this rally that you saw in 2025, small and mid caps on a price to book basis still traded about 1 times book. And if you look at some of the other regional markets like Malaysia, they're small and mid caps. Hong Kong, they're small and mid caps. Japan, Korea, they're small and mid caps. Singapore trades at about a 30 to 50% discount to the small and mid caps in these markets. So there's a huge valuation gap, despite the fact that you've had a bit of a rally happening. And I think the differential now, Sengya, is going to be MAS has announced all these changes, but now they have to start implementing them. And I think the real rally is going to happen when the implementation starts to happen. One of the things that we are very, very excited about is the Value Up program that MAS has announced, where they're putting in about $30 million to help companies, improve communications with their investors, strategize better in terms of their business models, and unlock value and generate a lot more returns for their shareholders. A bit like what the large caps have actually gone through. And I think that will actually drive the next phase of growth for a lot of these small and mid caps, like what we have seen in some of the more advanced developed markets in North Asia, like Korea, like Japan, like China, who have actually gone through some of the, gone through these restructuring programs, probably about a year, 2 years ahead of Singapore. And Also saying, yeah, one interesting thing, that came out while I was working on this report was that if you take the last 5 years, now we talked about a lot of these large cap reforms that were happening. The small caps didn't really go through a lot of reforms, but fundamentally, their earnings actually accelerated a lot more than the large caps. Earnings for the small and mid caps accelerated every year at about 5 to 10% faster than the large caps. So even without any reforming or restructuring. So just imagine what sort of earnings unlocking, a value unlocking that can happen when you actually have a directed, strategy to actually restructure a lot of these companies. So I think we are very, very excited about how the small and mid caps will perform over the next few years as well. And just to give a comp, if you look at the North Asian markets I've talked about, once the reform implementation started happening, on average, these markets re-rated about 40%. So I think that's something that we need to kind of watch out for as we progress into 2026.
That's great to hear. So it's excellent to hear that you think the STI index still has quite some headroom to go for 2026, and you've listed a fair bit of catalysts. Many of which I think has been already announced in the newspapers. Some of which is only known to professional specialists like you. What do you think are the key catalysts that markets may not have priced in?
I think there's actually three. One is AI. I mean, I think everyone talks about AI, but I think a lot of people talk about AI from the concept of data centers and putting in a lot of infrastructure. But I think what's interesting for Singapore is Singapore's kind of led this AI implementation over the last 2 years. We've had a national policy on AI since 2019, which means that a lot of AI use cases are now ready for prime time. In fact, when you look across a lot of the large cap companies in Singapore, a lot of them are already using AI. Adoption is very, very high. So which means that over this year, we think AI is really going to grow up for Singapore, and that's going to drive earnings, and it's going to drive margins for a lot of companies, and that's going to surprise a lot of people on the upside in terms of earnings upgrades. But there's two more catalysts as well. The other one is actually some of the enhancements that MAS is doing to the market microstructure. Is that they're making it easier to bring in a lot more liquidity into the market through market making. They're making lot sizes smaller, so that you can trade with less money than before. So all of this will actually encourage more retail participation. Now, if you actually look at a lot of comparable developed markets, Singapore has one of the lowest retail participation rates we estimate for a market our size. So I think this will actually encourage more retail to look at opportunities home rather than going overseas. So that will, I think, plus I think the fact that they're making IPO process easier will actually bring in more listings, which will actually increase the diversity of what is available in Singapore. So all of this will help with liquidity. Okay. The second one is actually falling interest rates. Singapore's interest rates are falling a lot faster than the Fed cuts for the first time in history. And part of that is the safe haven flows that are coming into Singapore that's driving a lot of liquidity domestically. And that's a good thing because that's driving overall deposit yields down. And what happens when deposit yields go down? People look for higher yields, they look for more risks, and we think there'll be a rotation into the equities market where the STI alone offers close to 5% dividend yield, which is far significantly better than what any fixed deposit gives you right now. So I think all of this will also help drive the STI higher towards our new target of 5,600.
5,600. Okay. All right. We'll pin that to our desk. Let's start taking a look at in terms of your sector favorites, and later on we'll move on to some of the stock picks featured in your report. So for your sector favorites, can you list them for us then and walk us through in terms of what are your favorites down to the least?
Sure. So, I think, as I said, we've got like these four big themes that will play out this year: certainty premium, large caps reforming, small caps and small and mid caps coming from behind and restructuring, and AI, and a lot of liquidity coming through from falling interest rates. So from a sector favorite point of view, we like the REITs. I think this can quite easily be the year for the REITs as the spread between the risk-free rate and the dividend yields for the REITs increase. We also think the banks and financials will do well. Now, this is counterintuitive because interest rates are falling, but we actually think for the Singapore banks, they've actually done well in the past during low interest rate environments. In fact, most of their existence, unlike a lot of the other regional banks, they've actually lived through low interest rates. So we're not as worried. We actually think that the earnings growth for these banks will remain positive for this year because you'll have stronger loan growth, plus also stronger fee growth coming through because of wealth management, safe haven flows, and also much more market-driven activity like IPOs, IBNA, and so on and so forth. And as I mentioned, some of those AI use cases will first appear in banks to keep their costs down. We've actually we have a very interesting chart that we've seen where we've actually seen the productivity or operating profits per employee for the banks have actually been growing over the last 3-4 years very consistently, while the workforce has actually been falling. So that actually kind of shows that some of these technological investments are starting to drive real margin growth as well. Then we also like the small and mid caps. As I said, a lot of the restructuring is going to happen there. So there's going to be a lot of interesting stories in this space. So that's another sector that will do well. The internet sector, I think a lot of the big internet regional names will do well this year from their own sort of growth around the region, and also they're managing costs, as well as the telcos, particularly the domestic oriented telcos in Singapore. I think there's now competitive rationalization happening. The whole data center AI theme also driving a lot of growth. Plus, a lot of these companies are looking to return capital as well. So I think in terms of what we like, those are some of the key sectors that we're excited about.
Cool. Let's talk about stock picks right now. And I'd like to, with the time remaining, I'd like to cover a balanced basket covering large caps, mid caps, and small caps, and hopefully one IPO as well. So let's start with the banks. I mean, the bank sector, as you mentioned earlier, has done so well last year, right? And this year, falling rate environment, it's questionable whether the valuations can continue staying on, whether flows will continue driving into some of these stocks. OCBC, as we saw, has had the strongest set of results among peers. Are these going to be the same drivers that will carry the momentum for OCBC going into 2026 in your view?
Yes and no. So, if you actually look at the banks, what's interesting is pretty much most of the re-rating of the banks last year was driven by retail flows. Institutionals are actually very, very underweight. So I think it's not going to take a lot. If the banks start surprising on the upside, you'll have institutional money rotating back into the banks. Now, what's interesting about OCBC is that last quarter was the first quarter we actually saw this one OCBC synergies starting to come through. This is where they've integrated the bank, the private bank, the stock brokerage, insurance, all as one entity and trying to drive operational efficiencies. And that seems to be working, and you're starting to see that appearing in ROEs. And I think one of the drivers that are kind of underappreciated for OCBC is their gearing towards Singapore's SMEs. One of the biggest drivers right now in Singapore is a construction boom. We have about $100 billion of projects that are running all the way to 2040. So that this is going to benefit a lot of small and mid caps who are the suppliers and executors for this construction boom, and OCBC will be servicing a lot of them. So that's again something that will drive growth. Plus, their private banking arm also will benefit from some of these safe haven flows. And their provisions and capital levels are very, very high. They're amongst the highest amongst the three banks. So, and they've got a new CEO who just started at the start of this year. He will, I think, want to make a mark for himself. One of the biggest issues that OCBC has had is that they have been a little bit more stingier in terms of capital returns than the other two banks. So I think there might be a little bit more focus on delivering capital returns to shareholders this year. That'll actually drive yields higher as well. So I think there's a few new factors for OCBC to continue their re-rating and catch up DBS, which it has underperformed this year.
Okay. Let's talk about the consumer sector and food empire in particular. This small mid cap, as you have identified in your report, has very strong regional growth potential this year. What's driving this growth trend?
Yeah, so I mean, if you look at most of last year for Food Empire, the growth actually came from Russia, Ukraine, Kazakhstan, the CIS countries. But this year, I think the center of gravity is going to change towards Asia, particularly to Vietnam and Southeast Asia. Production capacity in the plants in Vietnam are going to go up about 15% this year, another 30% next year. So you're going to see much stronger volume growth as well as margin growth coming through for the stock as well. And at the same time, I think for a lot of shareholders, 2025 is going to be a very strong year when they close because of all this growth that they've had. So there is this potential for this company to issue bonus dividends and also special dividends to reward shareholders as well. So there's quite a few exciting catalysts for this company going into this year.
Okay. On the industrial sector, let's talk about CSE Global. We've heard you mentioning about this stock a couple of times in 2025, and I think the share price has done relatively okay. This is the only proxy to the U.S. data center and electrification play. Where are we in the data center cycle, and what are your expectations for CSE this year?
I think, if you look at most of the industry experts, we're still looking at continued and accelerating investments in the data center space, particularly in the US. And I think now with US economic policies and Trump policies very much focused on bringing investments onshore into the US, we think, having that sort of US exposure is very, very important, and you're going to see continued growth there and in the right space. And I think also the fact that CSC has a Magnificent Seven partner, Amazon, who is giving them, who is expected to give them about $1.5 billion US dollars worth of orders over the next 5 years, plus own about 8% of the company, is a very strong catalyst as well. So this actually is a cheap way and an easier way to get some exposure to Amazon than as well. So I think you got the structural data center cycle. Plus, you got this Amazon exposure with, almost sort of guaranteed offtake of capacity for the next 5 years and some Amazon ownership as well. So I think the company is in a very, very strong position to continue to deliver at these levels.
Okay. Well, last but not least, let's talk about one IPO, Coliwoo. Now, this is the largest co-living player in Singapore. Talk us through about its strategy and growth upside.
Yeah, I mean, I think the share price has kind of gone a bit sideways after IPO, but we're actually very, very bullish on the stock. They're the largest co-living player. One of the largest co-living players in Singapore, has about 20% market share, about close to about 3,000 rooms at the moment. Now, we think they're actually one of the biggest beneficiaries of Singapore's safe haven status outside of the financial flows, because I think, you got Singapore being the regional financial center, business hub, education hub, medical hub. So that's going to drive a lot of demand for professionals to come into Singapore, and for a lot of young professionals to come into Singapore. And I think for a lot of them, having this sort of co-living optionality is very attractive. And we think that this is something that will continue to grow over the next few years. As I said, they've got about 20% market share of co-living in Singapore with about 96% occupancy already. Now, what's interesting is that capacity will grow by about a third by the end of 2026. So that's going to drive more earnings growth coming through. Plus, what we also like is that management is pursuing asset-light policy. So that what that means is they want to drive more capital returns to shareholders, keep their balance sheet fairly light, and expand ROEs. So we actually think that there are risks to management paying out a lot more than the officially guided 40% payout ratio as well. So quite a few things that can surprise on the upside for Coliwoo as we go into this year.
Okay, great. Well, thank you so much for your time today, Dylan, for sharing your ideas. Well, to our audience, also appreciate your time in spending with us this afternoon. In case you've missed the report itself, it was flashed on a QR code earlier in this segment. But if not, kindly contact your sales representatives and they'll be more than happy to basically send a copy of that report to you. So again, thank you for spending for your time with us, and we look forward to seeing you again next Monday. Thank you.